Everyone tells you to buy the S&P 500 and hold forever. And for most people, that's fine. But what if I told you 3 ETFs have been quietly crushing it, and almost nobody is talking about them? One returned 700% in a decade. One returned 112% in a single year. And one is the high-conviction bet on the future that Wall Street loves to hate. Let's break down all 3. Number 1. VGT, the Vanguard Information Technology ETF. This is the S&P 500 killer nobody talks about. VGT tracks the entire U.S. information technology sector, over 400 companies, for an expense ratio of just 0.10%. That's almost free. Over the last 10 years, VGT has returned 692%. The S&P 500, 234. That's nearly triple. And it's not some obscure leveraged product. It holds Apple, NVIDIA, Microsoft, Broadcom, Salesforce. The company's actually building the AI infrastructure wave. The average annual return over 20 years is 15.5%. You would have doubled your money every 4.5 years. If you believe technology keeps eating the world, and it clearly is, VGT is the purest, cheapest way to ride that trend. The risk? It dropped 30% in 2022. It's concentrated. When tech sells off, VGT sells off harder. But every single time, it's recovered and made new highs. Number 2. COPX, the Global X Copper Miners ETF. This is the one nobody on finance Twitter is recommending. And that's exactly why it's interesting. COPX returned 112% in the last 12 months. That's not a tech stock. That's copper miners. And the thesis is dead simple. Every electric vehicle needs 80 kilograms of copper. Every AI data center needs massive copper wiring for power delivery. Every solar panel, every wind turbine, every grid upgrade, copper. And the world has been in a structural supply deficit for 5 consecutive years. New mines take 7 to 15 years to open. You can't just flip a switch. JP Morgan is bullish on copper. Bank of America sees it going significantly higher. And with the Iran war disrupting Middle Eastern supply chains and oil hitting $90, commodities are back. COPX trades at an 18 times PE with a 2.3% dividend yield. It's volatile, this thing swings hard. But if you believe electrification and AI infrastructure demand are real, copper miners are one of the most asymmetric bets in the market right now. Number 3. QQQ, the Invesco Nasdaq 100 ETF. If VGT is pure tech, QQQ is tech plus the best of everything else. It tracks the 100 largest non-financial companies on the Nasdaq. So you get Apple, Amazon, Google, Meta, Tesla, Costco, and PepsiCo all in one fund. Over the last decade, QQQ has annualized around 22%, the S&P about 14%, and the expense ratio is just 0.2%. The reason QQQ consistently beats the S&P is concentration. The S&P holds 500 companies, including banks, utilities, and energy. QQQ holds 100, and they're the 100 that actually drive innovation. When AI spending accelerates, when cloud grows, when digital advertising expands, QQQ captures all of it with less dead weight. The risk is the same as VGT, concentration. When the Nasdaq sells off, QQQ drops hard. But for anyone with a 5-year horizon or longer, QQQ has been one of the most reliable wealth-building machines in market history. So what's the chaos capital take? If you want the S&P 500 on steroids, VGT. Pure tech, almost free. Nearly 700% in a decade. If you want the commodity play nobody sees coming, COPX. Copper is the metal powering EVs, AI, and the entire energy transition. 112% in 1 year speaks for itself. If you want the balanced growth machine, QQQ. The best 100 companies on the Nasdaq, consistently outperforming, low cost, battle tested. You don't have to pick just one. Stack them. Diversify across the 3 biggest macro trends of the next decade: technology, commodities, and innovation. The capital markets are chaos. Embrace it. And I'll see you in the next video.